What was the big lesson for banks in this year's stress tests? It could be this. Take your best swing. Fed doesn't mind if you miss. That's what we learned from Goldman Sachs, JP Morgan, and Morgan Stanley. Here to explain and discuss are Guy Moszkowski, managing partner at Autonomous Research, and his colleague, Brian Foran. Between them, they cover large, mid-sized consumer and regional banks and credit card companies here in America. It's a long list, gentlemen. Welcome.
Welcome.
Would you agree that that is the biggest surprise? These three banks, Goldman Sachs, JP Morgan, Morgan Stanley, all submitted to the Fed a request to return capital, raise dividends, buy back stock. We're told, no, that's too aggressive. You got to dial it back. But they got as much as they could, in theory.
Exactly, and I think that that's what you want to see. I wouldn't get too bent out of shape about the mulligan, taking the mulligan as a stigma, because what investors really want to see is that the banks within reason are asking for as much capital return as they can get, and the process is designed to allow for that.
Then it's not a stigma. It's just like any other negotiation. You ask for too much and you find your way in the middle?
I think that's right. And I mean, if you look at prior years, the big difference is the mulligan versus the qualitative fails. So the qualitative fails in past years, shut off your dividends and buyback for 6 or 9 months, go spend $100 million on a new tech system. It was pretty painful. The mulligan is, you know, I asked for $4 billion of TRUPS redemptions and I only get $3 billion. It's just kind of a negotiation.
I was on the call yesterday that senior Fed officials held with reporters and asked explicitly, does the Fed view this mulligan, right, the resubmission, with any prejudice? And was told, no, on the contrary, there's absolutely nothing wrong with it. So I'd have to, it makes me wonder why Goldman Sachs is the only firm to have figured this out 2 years in a row, and why other bank CEOs haven't been more aggressive with their capital requests, because if I were a shareholder, that's what I'd be wanting them to do.
You're right.
Like everybody should be resubmitting.
Yes, but I think that there is a caveat to that, which is that if you ask for aggressively too much, then I think you could be viewed as being somewhat reckless. So there's a fine line.
That's right.
So this is a dance.
Yeah, they don't want people shooting for the moon. They want this as a genuine difference of opinion where you round it to 5.1 and they round it to 4.9 on your stress minimum rather than really ding you, just kind of fix the problem.
So would you expect to see more banks resubmitting next year on the basis of what we've learned these past 2 years?
The obvious lesson would be to do that. Again, within reason.
Right.
Then what's your takeaway? The stress tests are done. What's your number one feeling about all of it?
Well, I think one of the most important takeaways is that when all is said and done, especially for the banks that are not the very, very biggest, that are systemically important, the capital return that they're being allowed to give back, dividends and buybacks, is kind of creeping forward. And we're getting to the point where banks are going to retake their place at the table as among the very largest producers of dividends for investors.
I'd echo that. I mean, maybe a couple numbers to frame it. The average payout ratio for the banks we cover is 72%. The consensus coming in was 65, and the 25-year average is 75. So a little bit better than the consensus was looking for, and actually within spitting distance of kind of what we all thought was normal 10 and 15 years ago.
Explain to everybody what the payout ratio is.
Yeah, so it's just the total dividends plus buybacks divided by your earnings. So generally, if you're thinking about a company in steady state and you're a bank, you're growing your balance sheet kind of modestly 4 or 5% a year, you should be able to pay out 70 or 80% of your earnings and keep your capital ratios
But
flat.
as we see here, card companies are being given the go-ahead, the green light to return a great deal of capital relative to earnings. The big Wall Street banks are still being penalized. Why?
I think this is the remaining rub. The standard for the big banks is legitimately higher, both in terms of the amount of capital they have to hold and the process they have to produce to show they're doing the stress test right.
Why are they being effectively checked twice? Right? They have to hold more capital.
Right.
We get that. Right? The belt and suspenders approach, whether it's on the leverage ratio or the capital ratio. The banks have to have more capital. The big banks have to have more capital than the small banks. Shouldn't that be enough, though? If you've got lots of capital, why should you be restricted in what you're able to return to shareholders out of your excess?
I think we're still close to the crisis when those are the banks that needed bailouts or came very close to needing bailouts, and bailouts are politically very, very unpopular. So there's an element of politics here as well.
All right, let's stop being so nice. Let's talk about the losers. Deutsche Bank and Santander. What does it mean for them?
This was expected, and it's not the first time for Santander. And for Deutsche, it was well expected that they're going to probably have to go through a couple of cycles, I think, before their U.S. business is viewed as having the controls in place. But it really wasn't that much of a surprise.
Guy, you evaluate. I mean, you don't rate Deutsche Bank, but you know the firm well because it competes so directly with the likes of Citigroup, BofA, Goldman, Morgan Stanley, JP Morgan, etc. in some of these core investment banking and capital markets businesses. What does a failure like that say about a Deutsche Bank?
I think it says that they probably have to pay a lot more attention to controls and systems that the Fed wants to see in place for their U.S. businesses.
But does it mean they're poorly run?
Here's what I will say. I will say that I think that the non-U.S. banks have had a tendency to view the U.S. regulators as secondary or tertiary, and they have played historically more by the rules of their home market. And what the Fed is saying again and again is that if you want to play in our capital markets in the United States, then you must play by our rules.
Except if you're one of these banks like Deutsche Bank, you make a ton of your dough here in the United States. So shouldn't you pay attention to our regulators?
I think more and more we're going to see that.
Brian, if we look past the big banks and their competitors like Deutsche Bank, for example, into some of the companies that you cover more closely, the super regionals, for example, the card companies, what are the biggest lessons to take away from these tests?
Well, I mean, I think that you're back to normal on payout ratios, right? Your dividends are lower, your buybacks are bigger, so there's a little bit of a mixed difference. But if I look at companies like Capital One or U.S. Bancorp, they're kind of at normal levels, 80s, 90% payout ratios. I think the one who's kind of in one foot in the other, one foot in one half, the other foot in the other half is Wells Fargo, right? And that's always been the debate. Are they a big mega bank because they've got $1.7 trillion of assets that kind of looks like a JP Morgan? But if you look at it, they're just a really, really big version of PNC or U.S. Bank.
They're a lot more plain vanilla than I would say at JP Morgan, wouldn't you?
They are, and you kind of see that, though, in the results. So they got a payout ratio of about 70%. So they're not as high as some of the other peers I referenced, but they're higher than BofA, Citi, JP Morgan. If you look at the one wrinkle, though, it's that the CCAR, and this is true for a lot of banks, not just Wells, it's effectively their binding constraint for capital. So you've got all this, SLR ratios, you've got G-SIBs, you've got a million Fed pronouncements, and then, oh, by the way, none of that matters. It's really CCAR. That's your limiting factor.
Why is it that the Fed seems to like the idea of buybacks more than dividends?
Dividends, I think, are correctly viewed by the Fed as much more of a commitment, right?
An ongoing commitment.
An ongoing commitment. I think when a bank sends a signal by stopping their dividend or reducing their dividend, that is viewed historically as a much more important signal.
Do you think we'll see them relax the rules and allow the dividend payout ratio to go up next year?
We think that we detect that there's been a little bit of that behind the scenes because several of the banks, not the big mega banks, but the regionals have crept up into the above 30% payout ratio space based on their actions yesterday.